My name is Elise Olwig, and today I'll be discussing Darling Ingredients, ticker DAR. Darling Ingredients engages in the production of sustainable natural ingredients from edible and inedible bionutrients. They operate through their feed, food, and fuel segments. The company processes animal byproducts into specialty ingredients such as collagen, fats, plasma, pet food ingredients, fertilizers, fuel feedstocks, and more. In addition, through a 50-50 joint venture with Valero Energy, they also operate Diamond Green Diesel, where animal fats, recycled greases, and used cooking oil are converted into renewable diesel. Revenues derive predominantly from the United States, with a growing presence throughout Canada, China, and Europe. Founded in 1882, Darling is headquartered in Irvine, Texas. Darling Ingredients is a leading processor of the world's inedible meat byproducts, repurposing 10% of the world's total volume of slaughterhouse wastage. The end products from this process include non-food oils and protein meal, non-food grade fats, animal feed, and natural casings. Additionally, Darling is the largest collector and processor of used cooking oil in North America, which is refined and used for renewable diesel. Key to this story is the Diamond Green Diesel joint venture. Diamond Green Diesel 1 started operations in Norco, Louisiana in 2013 with an initial production capacity of 160 million gallons per year, which they have since built out to 290. In quarter 3 of fiscal year 2021, Diamond Green Diesel 2 opened in St. Charles, Louisiana near Norco, and added an additional capacity of 400 million gallons per year, bringing total capacity to 690. There's a third plant currently undergoing construction in Port Arthur, Texas, which once completed will bring total capacity to 1.2 billion gallons of renewable diesel per year, deeming Darling Ingredients the second largest renewable diesel producer in the world. Notably, renewable diesel is a true hydrocarbon and a lower emission, cleaner burning fuel that can seamlessly plug into existing infrastructure with no switching costs. Through vertical integration with the Diamond Green Diesel joint venture, Darling Ingredients is extremely well positioned to capitalize on industry tailwinds in a growing market that mandates low-carbon fuels, such as California, Canada, and Europe, with downside risk protection from historically solid feed and food segments. Thus, it is recommended that Darling Ingredients be added to the AIM Domestic Fund with a price target of $105.74. First driver. Renewable diesel demand is expected to reach 5.1 billion gallons by 2050 from 0.6 million gallons in 2020, representing a 53% CAGR. The healthy demand environment is propelled by regulatory incentives such as the California Low Carbon Fuel Standard, or LCFS, which is designed to decrease the carbon intensity of California's markets, awarding tax credits to corporations buying and selling renewable fuel. Darling Ingredients currently commands a large proportion of this market. Similar legislation is also in the works in New Mexico, Colorado, Washington, and Oregon, among others. Additionally, sustainable aviation fuel continues to gain traction with the Biden administration, as they aim to slash aircraft emissions by 20% by 2050. Globally, Canada is also moving to create a standard like LCFS over the next 12 to 18 months, while other numerous European countries have already set stringent standards. Diamond Green Diesel has perfected the conversion method hydroprocess esters and fatty acids, synthetic paraffinic kerosene, or HEFA SPK, which is the most well-proven and lowest cost of capital method to fulfill market needs in the SAF market. The feedstock to fuel conversion rate is as high as 90% versus 15 to 20% for alternative methods. Competitors seeking additional production capacity to fill SAF and other increasing demands must deploy $20 per gallon in capital expenditures, whereas DAR can add capacity for a mere $4 to $7 per gallon. In addition, DAR's use of tallow, or animal fats, in renewable fuel generation is also more cost-effective and overall more profitable, as competitors use plant oils. EBITDA on renewable diesel from tallow has historically outpaced that of soybean oil by 75 cents to $1 per gallon. Darling also benefits from more favorable raw materials procurement through vertical integration with Darling's legacy segments. Overall, Darling's operational expertise allows the firm to go to market with among the lowest cost structure in the industry. Darling's legacy food and feed segments proportionally benefit from an increasing demand in the renewable diesel space. Within the feed segment, Darling processes used cooking oil and restaurant oils. These refined oils have a growing degree of scarcity value given the structural shift to renewable diesel, and Darling benefits from long-term supplier relationships that will provide Diamond Green Diesel with ample raw materials to meet renewable diesel demand. In addition, the availability of feedstocks such as inedible tallow are expected to reduce by 0.5 billion pounds or 40% through 2032 as Darling takes 40% of their original capacity off the market. While competitors face increasing pressures to lock in feedstock and oil suppliers, Diamond's affiliation with Darling allowed the venture to capture market share without facing capacity constraints. The 10-year DCF model was constructed using a terminal growth rate of 1.25% and a WACC of 7.66%, which resulted in an intrinsic value of 96.58. Additionally, a sensitivity analysis on the terminal growth rate and WACC of plus or minus 50 bips ranged from 77.83 to 131.57. Additionally, a PE multiple valuation was constructed using a blended average PE of 23.37 times, which resulted in an intrinsic value of $107.39. Finally, a sum of parts model was constructed based on a blended average EBITDA multiple of 10.5 times for the base business and a 1.6 times blended average EBITDA per gallon multiple for the Diamond Green Diesel joint venture, which resulted in an intrinsic value of $131.54. By weighing the three models 60-20-20, an intrinsic value of $105.74 was reached, resulting in a potential upside of 30.70%. Three key risks include slaughterhouse efficiency, severe weather, and competition. The consolidation of the meat processing industry may lead to more efficient operations and therefore less byproduct to process. In addition, extremely cold weather can hinder raw materials collections, while excessively warm temperatures may cause deterioration. Lastly, given the expanding regulation incentivizing the production and use of renewable diesel, large energy companies and other companies are tapping into this space, which could erode Diamond's margins. Randall Stewie was appointed CEO and chairman after serving as EVP at Conagra Foods with additional experience at Cargill. Sandra Dudley is the EVP of Renewables with previous experience at Conagra and Tenaska Marketing Ventures, a top natural gas marketer. Thank you, and I look forward to Q&A on Friday, November 12th.